We learned about the idea behind the revenue recognition principle, and we also discussed an example. Now, let us talk about the expense recognition principle.
Yahoo!
Imagine yourself as a sportswear seller. On March 1, 20X1, you paid $30 for a pair of shoes to sell it in your store. You subsequently sold it for $40 on April 5, 20X1. Which of the following is true? $30 should be recognized as an expense immediately on March 1, 20X1 after it was bought. $30 is only recognized as an expense when the pair of shoes are sold on April 5, 20X1. If you recognize the expense on March 1, 20X1, the income on the interim financial statement ending March 31, 20X1 will be understated. The expense should be recognized only after the shoes were sold, and the related revenue is recognized on April 5, 20X1. Adjusting accounts. Most businesses use the accrual basis of accounting as this is required by the accounting standards. That is why adjustments are necessary for transactions and events that extend to more than one accounting period. After learning about the difference between accrual and cash basis of accounting and the importance of matching the expense to the related revenue, we now discuss the 6 common types of adjustments. These are adjustments for revenues that have been earned and expenses that have been incurred even without the actual receipt and disbursement of cash. Under the accruals, we have accrued revenues. These are revenues already earned in an accounting period that are unrecorded because there has no cash collection made yet. The adjusting entries for accrued revenues increase the assets and increase the revenues. An example of this is a carpenter who bills his customers only when the job is done. If only 1/3 of the job is done at the end of the period, then the carpenter must only expect 1/3 of the billing to be recorded as revenue, since that is what he has earned, even though there is no actual cash collection. A common example of accrued revenues arises from services, interest, and rent. Steps to adjusting accounts. Before we step up our examples, you need to learn this first. When adjusting accounts, try to follow these steps. Step 1. Identify the current account balance. Step 2. Identify what should be the account balance. And Step 3. Record an adjusting entry to get from Step 1 to Step 2. To illustrate how to adjust, let's look at an example. ABC Company was hired for a 30-day consulting service to a local restaurant for a fixed rate of $1,200. ABC Company is to provide services for 30 days from December 22, 20X1 to January 20, 20X2. The local restaurant paid immediately after the service was completed. ABC recorded revenues on the day of payment, January 20, 20X2. The company uses the calendar year as its accounting period, meaning it will end on December 31. Step 1. Identify the current account balance. First, we must identify the balance of the accounts to be adjusted. In ABC's case, the revenue earned is not yet recorded, so revenue is still zero as of December 31, 20X1. Step 2. Identify what should be the account balance. On December 31, 20X1, 10 days of services have already been provided. ABC Company has neither billed the local restaurant nor received the payment, and the services were also not recorded. Even so, ABC has earned 10 days of the 30-day contract, or 1/3 of the fee. ABC company must report $400 revenue on its income statement. Step 3. Record an adjusting entry to get from Step 1 to Step 2. To account for the accrued consulting revenue, the year-end adjusting entry on December 31, 20X1 is debit accounts receivable and credit to accrued consulting revenues for the amount earned, 20,000 pesos. Notice that we used the word accrued in the account title to indicate that the revenue is yet to be collected. However, using the normal account title, for example consulting revenue, is also acceptable. Always refer to the chart of accounts to know what account titles are used by the company. Before adjustments, the accounts receivable account of ABC company is 0. And after the adjustment, the accounts receivable increased by $400. The same increase as consulting revenues account. The revenue would be improperly recorded on January 20, 20X2 if no adjusting entries were made. What if the 30-day consulting period began on December 12, 20X1 instead of December 22? The journal entry would be debit to accounts receivable and credit to accrued consulting revenue, amounting $800 derived from 2/3 of the total services. Aside from accrued consulting revenue, another common revenue accrual is accrued interest revenue. You should know that interest can also lead an accrued revenue when a debtor owes money to an entity. If an entity lent money to a borrower, accounts should be adjusted to record any earned yet uncollected interest revenue. The adjusting entry is pretty similar to that of accruing consulting revenue. Debit interest receivable and credit interest revenue. Example: on October 1, 20X1, XYZ Lending Corp. lent $600 to a borrower with a 12% annual interest rate, payable on September 30, 20X2. On the reporting date on December 31, 20X1, the interest earned will be $18, derived from multiplying the principal amount with the 12% interest rate multiplied by 3 months earned divided by 12 months. Take note that the interest rate is for 1 year, thus we used 3/12 and multiplied it to the interest rate of 12%. Next, accrued expenses.